Hi, this is Chris McCauley with Strategic Planning Group. Today I'm going to give you a brief summary of the first quarter 2021 market results and talk about the remainder of this year. We'll go back into 2020 to give you some context on the last 12 months of the stock and bond markets, and I'll try not to bury you in numbers. It's been a roller coaster in the markets the past 12 months. In March of 2020, the S&P 500 was down 34%. But finished the year at a plus 18%, a wild swing. For the first 3 months of this year, it's up 6%. Unlike 2020, when the increase was driven by growth stocks such as Apple, Amazon, and Microsoft, this year's gain has been driven by value stocks. In fact, almost 25% of the S&P 500 at the end of last year was large tech stocks. I've included growth and value on the screen, and you can see the difference from 2020 to the first 3 months of 2021. The value stocks began rising in November 2020 after the Pfizer and Moderna vaccines were announced. The announcements brought into focus an expected economic recovery and end of the recession. Value stocks hurt by the recession began to move up with the expectation of the economic recovery. Energy, financial, and industrial sectors all moved up. Smaller company stocks surged after the vaccine announcements after being crushed earlier in 2020. You can see from this chart the rise in worldwide vaccinations beginning in December 2020. The stock market does look forward and expects an economic recovery in 2021. If there was one thing to the past 12 months, it's that different parts of stock and bond markets moved very fast down, then up at different times, confirming the need to be a diversified investor. While we see positive numbers in the U.S., international, and emerging markets for the first 3 months of 2021, the Bloomberg Barclays Aggregate Bond Index has declined by 3%. Interest rates have been rising. Not short-term rates, which the Federal Reserve Bank heavily influences, but intermediate and long-term interest rates. Most new mortgages are tied to intermediate-term interest rates, which is why we have seen mortgage rates rising. When interest rates rise, bond prices fall, which is why we see a negative return so far in 2021. Bluntly, so far it's been a lousy year to be a bond investor, but note that it's down 3%, not 30%, which would be a lousy year for stocks. It's very possible in 2021, bond investors may experience negative returns after a very good 2020 when interest rates fell. Looking ahead to the rest of 2021, I expect the economy to improve and the stock markets to reflect the improving economy. I think the combination of the Federal Reserve Bank holding rates low, the ongoing fiscal stimulus from the federal government, and most of all, a large-scale worldwide rollout of vaccinations are all good signs for a good year in the stock markets. As investors of our clients' money, I do not try to pick winning sectors or styles such as value and growth. I believe in asset allocation and matching your investments to your current and future lifestyle goals, not today's headlines. If you think this interests you, we'd love to meet with you and discuss matching your investment strategy with your goals. I'm an independent, fee-only advisor compensated only by my clients. Thank you and have a great day.